Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today's Tuesday, September 16th. Well, Tuesday was a roller coaster session as market participants considered the fate of insurer AIG and other struggling financial companies. The market also digested an FOMC decision to keep rates unchanged, an inline CPI report, and discouraging comments from Dell. The S&P fell 2% shortly after the opening bell, only to rebound to settle with a gain of 1.8% on a late session report that AIG may indeed receive a bailout. AIG was at the center of the volatility after the insurance giant had its credit rating downgraded at the major rating agencies, sparking speculation that the company would have to file for bankruptcy if it could not get a hold of cash. AIG fell as much as 74% as various reports said a private deal to help AIG is not going to happen and the Fed was not going to lend money. AIG closed with a loss of only 16%, however, after a late session Bloomberg.com report said that the Fed may end up giving the company a loan package after all. Lehman Brothers, which filed for bankruptcy Monday, sold its investment banking segment to Barclays, according to the Wall Street Journal. The sale will reportedly save 9,000 jobs. Goldman Sachs fell to a fresh 52-week low after reporting a 72% year-over-year drop in earnings per share. Revenue declined 40% in its investment banking unit and 67% in trading and investments. The financial market turmoil Monday prompted a doubling in the overnight interest rate banks charge to lend dollars, also known as the LIBOR rate. This led the Fed and overseas central banks to use repurchase agreements, which are secured short-term lending agreements, to pump liquidity into the system. The Fed was willing to add liquidity, but decided later in the day not to cut interest rates at the FOMC meeting, leaving the Fed funds rate at 2% and the discount rate at 2.25%. The FOMC's directive was very similar to the wording from August 5th, although downside risks to economic growth received additional attention. Inflation risks remain a significant concern to the Fed. In corporate news, Dell said it has seen a slowdown in global end-user demand. That sent the computer maker stock down 11% to its lowest intraday level in 10.5 years. Hewlett-Packard is laying off 7.5%, or 24,600 employees, and is taking a charge of $1.7 billion related to its EDS acquisition. Once the plan is completed, HP expects to save $1.8 billion a year. Retailer Best Buy reported second quarter earnings of 48 cents per share, which is 9 cents worse than the average analyst estimate of 57 cents. Despite a revenue increase of 12% year over year, earnings per share fell 14% due to increased spending related to store labor and the rollout of Best Buy Mobile. August CPI was in line with expectations, showing a welcome 0.1% month-over-month decline thanks to a decrease in fuel costs. The core rate, which excludes fuel and food, rose 0.2%. Crude prices tumbled for the second day in a row, falling 3% to $92.89 per barrel. Commodities as a whole slid 2%. In the end, 8 of the 10 economic sectors posted a gain, although 6 hit fresh 52-week lows in intraday trade. The financial sector climbed 6.2%, while the energy sector gained 3.9% despite the drop in energy prices. The utility sector, which fell 1.1%, underperformed as after Constellation Energy plummeted 36% on debt fears. Treasuries also had a wild day, with the 10-year note trading up more than a point in early trade and then ending the session down 43 ticks. I'm Pat O'Hare for Briefing.com. Thanks for listening and have a good evening.